Hello, everyone. My name is Lu Zhang. I'm the International Tax Director at Moss Adams. Today, I have the pleasure to talk with you about some of the international tax considerations and action items related to the COVID-19 pandemic. Initial reaction to the COVID-19 pandemic forced many companies to focus on the basics to help reduce expenses and maintain cash flow. As your business shifts from the immediate response to a more proactive plan aimed at sustaining operations through the duration of the pandemic and recovery after it subsides, consider focusing on some of the international tax strategies covered in this webcast. These considerations are likely to provide immediate and potentially long-term effect on your cash flow and cost savings. In today's webcast, we're going to divide the considerations into 4 buckets: cash management and repatriation, IP valuation and transfer, transfer pricing arrangements, and additional considerations. Cash management and repatriation. Although the U.S. economy has been severely affected by the pandemic, the U.S. dollar as the global reserve currency has only strengthened. Accordingly, most foreign currencies have declined in value against the U.S. dollar. Local currency fluctuation may decrease liquid asset values abroad, and foreign exchange uncertainty may make maintaining assets in foreign currency more risky. If your company requires cash at home, repatriating cash back to the U.S. could be beneficial, particularly because most foreign earnings could be repatriated tax-free from foreign subsidiaries. For companies closing or restructuring foreign operations, the repatriation of remaining cash may give rise to significant ordinary loss opportunities. Other cash flow management considerations include tax deferral, prolonged payments, management of withholding tax credits, and refund of VAT or customs duties. Moving on to IP valuation. We all know that IP valuation is linked to the relevant income forecast. Amid the current global economic uncertainty, IP values are likely to decline due to declining income or loss forecasting. However, this challenging moment could provide opportunity to consider migrating or realigning your IP. If your company transfers its IP to a foreign jurisdiction through a controlled transaction, the income from the transaction could benefit from the foreign-derived intangible income, aka FDII provision. The resulting tax rate could be 13.125%. Alternatively, if a US-based multinational group repatriates its IP from overseas, the same FDII incentive permits the lower tax rate on profits generated by the US IP until 2026. Revisiting transfer pricing arrangements. Transfer pricing regulations enforce an arm's length principle that requires pricing to be based on similar transactions done between unrelated parties. As your company shifts operations and conditions deviate from the previous business expectations, it might be necessary to update your intercompany transfer pricing arrangements to reflect changes brought by the pandemic. Some action items include conducting a supply chain review from a risk-bearing perspective, updating the corresponding transfer pricing methodology, and simplifying intercompany transfer pricing arrangements. As the profitability of comparable transactions likely declines, it could be possible or even necessary to adjust pricing to take market fluctuations into account. For example, a limited risk entity normally compensated at cost plus could potentially operate at break-even or share value chain losses based on updated methodology and comparables. Additionally, transactions subject to advanced pricing agreements, or APAs, could be impacted and may need to be revisited as the pandemic could significantly affect the profitability of global operations for years to come. Additional considerations. As the impact of COVID-19 evolves, decreased U.S. income may change a company's tax positions under numerous provisions, including the Section 163J interest limitation, the foreign tax credit limitation, and the base erosion and anti-abuse tax, or BEAT. Many companies that currently enjoy FDII or IC-DISC benefits may anticipate a drop in deductions as foreign profits decrease. Global and regional travel restrictions could jeopardize local entities' business substance. As a result, supplier income analysis and treaty benefits, among other things, could be affected. It is also important to consider adjusting exit strategies due to potential downward valuations and forecasts. As a cost reduction measure, companies may consider reducing compliance burden by closing down dormant or low activity entities and simplifying intercompany transfer pricing arrangements. Obviously, we cannot cover all the necessary considerations in this short webcast. Moss Adams has been closely monitoring the COVID-19 situation as it evolves, so we can provide up-to-date guidance and support to help you combat uncertainty. Please see our dedicated webpage detailing COVID-19 implications for you and your business at mossadams.com/COVID-19-implications. Here's my contact information. Please feel free to reach out if you have any questions or comments. That's all for today. Thanks for watching and stay safe.